There is a market operating right now that most people will never think about, never visit, and never consciously interact with. Yet it decides what your mortgage costs, whether your retirement survives a rate shock, and whether the economy is heading toward a recession. It is bigger than the stock market. It is worth roughly $145 trillion, and almost nobody who is affected by it actually understands how it works. That ends today. Let's start with the most basic question. What even is a bond? Strip away all the financial jargon, and a bond is just a loan. A government needs money. A company needs capital. Instead of walking into a bank, they borrow directly from investors like you. You give them a lump sum called the principal. In exchange, they promise to pay you a fixed amount of interest every year, called the coupon, and then return your full principal on a specific future date called the maturity. That is it. That is the whole product. What makes bonds powerful is not the structure. It is the sheer scale and the invisible reach they have over every financial decision you make. Now, here's the one rule that unlocks everything else in this video. When interest rates go up, the price of existing bonds goes down. When rates fall, existing bond prices rise. These two things always move in opposite directions, without exception. Here's why that matters. Imagine you buy a bond for $1,000, paying 3% annually. That's $30 per year. A few months later, new bonds are issued at 5%, paying $50 on the same $1,000 investment. Now you want to sell your bond. Nobody will pay full price for it when they can buy the newer, better-paying version. So the price of your bond has to drop until that $30 payment becomes competitive. At 5%, that drop brings your bond's market value down to around $600. You haven't lost any future payments. You still collect $30 a year and get your $1,000 back at maturity, but on paper, your investment just lost 40% of its value. Every major bond story you'll ever hear is just this one rule playing out at massive scale. Here's where it touches your actual life. The single most important bond in America is the 10-year U.S. Treasury. Whatever yield that bond is paying becomes the foundation for your mortgage rate. Banks do not invent mortgage rates. They look at the 10-year Treasury and ask a very logical question. Why would I lend money to a household for 30 years when the U.S. government is already offering me a risk-free return? The answer is they would not, unless you pay more. So they take the 10-year yield and add roughly 2 percentage points to account for the risk that you might default. This is not complicated. It's just math. That spread between the bond yield and your mortgage rate explains almost everything about why housing affordability changes over time. Between early 2021 and late 2023, mortgage rates swung from historic lows near 2.5% to nearly 8%. The house did not change, the buyer did not change. Only the bond yields changed, and it rewrote the math on millions of financial lives. Now, let's talk about what happened in 2022, because it exposed a dangerous myth that had gone unchallenged for decades. The conventional wisdom said that as you approach retirement, you shift out of stocks and into bonds. Bonds are the safe part. Bonds protect you. The classic 60-40 portfolio, 60% stocks and 40% bonds, was treated as the responsible conservative choice. The bond allocation was supposed to be the seatbelt. In 2022, the Federal Reserve raised interest rates faster than it had in 40 years, moving from near zero to over 4% in roughly 9 months.
Apply the rule we just learned. Rates went up, so existing bond prices collapsed. The broad U.S. bond market lost 13% in a single year, the worst annual performance since the index began tracking in 1976. Long-dated Treasury bonds lost nearly 40%. A university research analysis found it was the worst year for long-duration U.S. bonds going back to 1754. The country did not even exist yet, and the so-called safe sleeve of America's retirement savings was having its worst year in 268 years. The seatbelt did not work because the crash was caused by the exact thing the seatbelt was made from. There is a number that explains why some people got crushed and others walked away with bruises. It is called duration. Duration tells you how much a bond fund will lose for every 1 percentage point rise in interest rates. A broad bond index fund typically carries a duration around 6. That means a 1-point rate rise costs 6% of your investment. A long-dated treasury fund with a duration of 17 loses 17% on the same move. Most investors who owned bond funds in 2022 had never checked this number. They were told bonds are safe and stopped reading. That single act of not reading cost some retirees enormous sums of money they will never fully recover. There is another layer to this that most people overlook entirely. Individual bonds and bond funds behave very differently. If you hold an individual bond to maturity, price swings along the way are irrelevant. You collect every coupon and receive your full principal back on schedule. A bond fund is different. It never matures. It is a continuously repriced basket of bonds, and every increase in rates permanently marks down that basket on your statement. Beyond retirement accounts, the bond market also functions as an early warning system for the broader economy through something called the yield curve. Normally, longer maturity bonds pay higher yields than short-term ones. That makes intuitive sense. More time means more uncertainty, so you demand more compensation. When the curve inverts, meaning short-term yields rise above long-term yields, the bond market is signaling that it expects the Federal Reserve to eventually cut rates because the economy is weakening. According to research from the Federal Reserve Bank of San Francisco, every single U.S. recession going back to 1955 was preceded by an inverted yield curve. 10 recessions, 10 for 10. No other economic indicator has that track record. Here's the practical bottom line. The bond market is not a niche topic for Wall Street professionals. It is the operating system running underneath your mortgage, your savings account, your retirement portfolio, and the job market your employer navigates. Most large banks pay savings account rates well below 1%, while short-term treasuries and high-yield savings accounts offer several times that with equivalent safety. The difference between knowing this and not knowing this is measurable in thousands of dollars per year. If you have bond funds in your retirement accounts, look up the duration number right now. It takes 30 seconds and it tells you exactly how exposed you are to any future rate movement. The bond market will keep running whether you pay attention to it or not. The only question is whether it keeps affecting your life in ways you cannot see or in ways you can actually manage. If this video opened your eyes to something that was already shaping your finances without your knowledge, subscribe and share it with someone you know who is heading into retirement. This information should not be optional.